following is a Silver Bullion Television audiocast. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Our guest today is a renowned expert on incumbent energy systems. He is Gianni Kovacevic. Gianni is the executive chairman and a co-founder of CopperBank, a company that offers investors maximum optionality to future copper prices. An avid proponent of realistic environmentalism, Gianni has enlightened audiences around the world about how the environment and investments often go hand in hand. He is a published author with his 2016 book, My Electrician Drives A Porsche. We are delighted to have him here today as our guest. Good day, Gianni, and welcome to SBTV.
It's so nice to be here with you.
Great. We're glad to have you, Gianni. I've listened to several of your conference presentations over on YouTube, and I got to say, you have this captivating way of telling a story that definitely brings the audience into the world that you are painting with your words. Could we start by understanding what you mean by realistic environmentalism?
Well, that's basically the recognition that I don't have and I don't think anyone has the authority to tell people in the developing world that they are never going to have running water or electricity in their home. So there's going to be some more population growth. Eventually that might taper off to when we get to about 9 billion people. But I think conclusively in Africa, in India, in other parts of the world where people still don't have access to these things, they're eventually going to have it. And it's going to happen a lot faster than most of the pessimists would probably appreciate. And so we need to provide the natural resources for these people to start participating in, basic comforts in life. So that's what that is. It's not saying no to everything, because you have to have everything up here is either grown or mined. So that's a reality. So we have to be open. We just have to do those things in the most responsible way possible.
You published a book titled My Electrician Drives A Porsche back in 2016. And you embarked on the world's first zero-emission book tour, driving a Tesla electric car across the States and back up into Canada. Could you share with us what inspired you to do such a book tour in an all-electric vehicle and the experience of it all?
Yeah, at the time it was probably not so well appreciated that the fact that the future of mobilization is increasingly going to be electrification. Mm-hmm. That is all changing. I think we had the Volkswagen Dieselgate scandal. You've seen this proliferation particularly in China, and they're addressing transportation because of particulate pollution. And you alleviate that with long-term planning, and that China certainly does have that kind of long-term planning. And that's done with the electrification of transportation. And you have it in cities around the world. We've seen the mayor of London talk about not being able to drive a diesel vehicle in central London, or having to pay a heavy tariff. Mm-hmm. And so this will become electrification. Everyone recognizes now in the long run, in the next 20, 30 years. However, in the near term, it's happening a lot faster than most people will appreciate. So I wrote the book, which is how do we say this? It's an allegory. It's a personal finance book that's written like an adventure, like a story, mm-hmm. with two characters, and it's about showcasing that the future is now. And I drove the Tesla across America so I could engage with people to talk about that. People from all facets of the economy. I met with all levels of the media, and I think you can open that can of worms no matter who you're talking to, and sort of diagnose what's going on with this transportation revolution.
Okay, yeah, you've spoken quite a bit about how countries, they are gradually switching, some quicker than others, from incumbent energy like those from fossil fuels to what you call technologically advanced energy. And you have referred to this trend as the electrification of everything. When you say technologically advanced energy, do you mean renewable energy like solar, wind, electricity, perhaps nuclear?
It's all of the above. And if you embellish a map of all the countries that export oil, so the higher the value of a barrel of oil and the more oil that you export on this map that we're embellishing, the more important is that country. So what's the most important one? Saudi Arabia.
Yes.
Also important, Kuwait, Iran, Venezuela, Angola, Russia. But that's not where you need to focus. As an investor, as a consumer, as someone looking towards the future, you need to look at the countries that import those products. So what does not show up on this map? Well, Japan, China, Germany. These are all countries that, for the most part, do not have natural resources. Let's focus on Japan. For the past 100 years, there really wasn't a choice. Now, with all of these technologies moving forward in tandem, a country like Japan can put forward a 10-year plan, and it's talking about the way we create or generate energy or electricity, the way it's transferred, and the way consumers and industry utilize energy. It's all electricity. When you remove fossil fuels from that equation, you're either pivoting to a different type of fossil fuel, I'm talking about going into natural gas, or you're going to use energy vis-a-vis electricity. Transportation, electric trains, electric cars, electric buses, and then you can localize the creation of that electricity with large-scale wind power, with large-scale solar power, with micro-solar power, and then sometimes the peaker power, when the sun doesn't shine or the wind isn't blowing, we can now start using batteries, different types of energy storage, and natural gas, because it's just a far superior source of base load peaker power because it's instantaneous. Coal electricity takes days to turn up and down. Nuclear power takes weeks to turn up and down. Natural gas is immediate. So that basket, they're all going to be big winners. And what's the common bond, Patrick? We're going to segue into, guess what? Copper. Because all of that type of electricity runs through copper cabling, copper windings, copper connection points. So that commodity, copper, is going to have very robust CAGR growth rate, not just for the next 5 years, but for the next 20, 30 years. I will even say what oil was to the global economy in the past 100 years is what copper is going to be for the next 100 years.
Okay. Gianni, when did you start to take notice of this trend, and how important is it for us to realize that this trend is already on the way?
I studied electricity in British Columbia. I did that from 1992 to 1996, and many of the things that we studied and learned were, of course, fairy tales back in those days, the things we just talked about. And even 10 years ago, they were still not, commercially viable. We saw many startups, large scale, that ended up becoming failures because it was just a little bit too soon. But because it's all technology and it doubles every 3 or 4 years, we are now at a time where all of it is commercially viable, and it competes with the incumbent sources. It doesn't matter what we're talking about. And it will be largely, if it's going to be consumer driven because of the cool factor, the modern factor, the convenience factor, or it's going to be, for better or worse, it's going to be mandated by government, because they will say you cannot drive the old forms, the incumbent forms of energy after so many years. So they have to pivot into electrification of buses, of road transportation, freight, the creation of electricity, what have you. So I've followed it for 25 years, and all of a sudden it just is become recognized by, I think, more of the mass media. You still have people that are negative on these things. There's still the misnomer that they require subsidies. They don't. In some cases, of course, they do. But in most cases, they don't want subsidies anymore. Wind and solar on large scale competes with incumbent energy sources. And so too, when you look at the cost versus price, the price is what you pay on day one, but there's a cost. If you're going to operate something over 5 or 10 years, like a bus for a city, it is cheaper in the long run to use electrification. And we use the world's largest bus market, the world's largest manufacturer of buses, number 1 and 2, of course, I speak of China. That is where they are already. You look at the example that BYD Build Your Dreams did in Shenzhen, China. They transferred the bus fleet of that general area. They did it very quickly. They have some 16,000 electric buses, and it's cheaper in the long run, and the collateral benefit is a reduction of particulate pollution.
Right. Johnny, you mentioned price and cost. Are investment dollars coming into the renewable energy sector now?
Um, they are, and they're doing it because of, in some cases, convenience, in some cases, because people are on the technological wave. You're not bludgeoned in the head with a 2x4 because you're addressing these things.
Uh-huh.
You know, you look at the mantra in China right now, it's no longer made in China. They call it innovated in China and then made in China and then exported around the world. So you become a leader in these forms of modern energy, the creation, the delivery, and the utilization of in all aspects. So there's people are gravitating to this, investors that is, because it's the future, there's a big opportunity there, and it makes money now.
Yeah. Um, you've oil, it's consumed globally by different sectors, and you've highlighted that big oil's biggest consumer or customer is transportation. I think transportation is over half of the consumption of oil. Could you reiterate for our listeners why this fact is significant and how it will impact us in the coming years?
Yeah, everything in the oil market is driven on the margin. So in 2014, 2015, we saw that the price of oil collapsed because of a 2 million barrel a day differential. That means there was just not enough demand to fit the supply of the global industry. And so that 2% differential collapsed the oil price 70%. So it has to be a balanced market. Oil is going to continue to be very important to the global economy, irrespective of the lack of demand growth. It's still, we consume right now about 98, 99 million barrels of oil every day. And it has grown pretty consistently since the year 1900. The question that the experts are asking is, when are we going to go into terminal decline? Well, some say it's 2040, some say it's 2030. Others are saying it's going to happen sometime in the 2020s. So it will still be important, but it won't be a growth industry. So the producers collectively, the three largest producers in the world that most people should know, Saudi Arabia is no longer the largest producer. The two largest producers are Russia and the United States, but all three can still increase production to some. They're about 11 million barrels a day now, and they could all probably get to 13, 14 million barrels a day, but they have to do it in a balanced way. And who's their biggest customer? We just talked about that. It's transportation in 4 different fields. Of all the oil that's consumed every day, about 6% is used in aviation, about 6% is used in the maritime trade with the freighters traveling around the world, 25% in road freight, and about 20% in passenger vehicles. Collectively, 55%. And we are going to see, if nothing else, efficiencies across the board. When you make the internal combustion engine more efficient, Patrick, you use less oil. That's just a fact of physics. So not only do you have substitution that's going to act like a pincer on oil demand, you also have not just about economic factors, these are mandated. Countries and economies around the world have said these things all have to be more efficient in so many years. So this is not bullish in the long run for oil consumption. When we do substitute out of these things, of course, we go into electrification, and the winner, CAGR growth rate winner, is going to be, once again, copper.
Yeah, yeah. I understand what you're saying. I think, for instance, China, I believe 10 or 12% of all new cars are going to have to be electric vehicles by 2020. So it's already happening. But how long do you think it'll be before we are weaned off oil, if it's at all possible?
Well, it's going to take a long time. Oil is still going to be a very important part of the global economy for, until, like, say, 2050, 2060. It may not grow, the demand for it, but it's still going to be a pillar. And we also have to look at the growth area within oil consumption, and that's enhanced products. When you crack a barrel of oil, you get 45 or 50 different products. We get plastic, polyester, petrochemicals, fertilizers. There's a lot of different things that come from a barrel of oil. So that area will, in fact, probably grow. So as far as oil, the extraction of oil, it's done in dozens of countries around the world, and the world's oil supply comes from approximately 4 million 700,000 individual wells, from the largest ones in Saudi Arabia to the smallest mom and pop in North Dakota or Texas.
Okay, yeah, I think currently electric vehicles, they make up only 1, perhaps 2% of vehicles globally. Knowing this, what is your view with regards to the challenges that electric vehicles have regarding adoption?
Well, it has to impact the consumer and the pocketbook. And if you look at the consumer behavior and what kind of car they want to buy, the incumbent automotive manufacturers have many issues. Okay, we talked about these governmental pressures, pollution issues, efficiency issues, but we also have to talk about the consumer of the future. If you look at a millennial, there are scores of millennials in China, in the United States, in Europe. They're not getting a driver's license anymore, Patrick. They've grown up in an environment where they can use something like Uber and or urbanization. So they don't want to live anymore. They don't want to get married and go live in the suburbs of Kansas City. They'd rather live in the gentrified central area of Kansas City and periodically use an Uber. If they are getting a license, that we find that they're using these car share services. So you can take a sampling of any 100, say 28-year-olds in any major city in the developed world or China, and I will suggest to you that there's a good portion of these millennials that either don't want to have a car, are not going to buy a car, or don't even have a license. There's a good sampling, a good percentage of them. So the impact is, for the incumbent automotive manufacturers, they know that these people are never going to become their future consumer. So there's ramifications for that. I believe that automotive sales, are actually going to stop growing. There will come a time, yes, for every one person in India or Africa that buys their first car, you're going to have 3 or 4 people in Europe, America, China that actually have no interest in buying a car. It's going to offset that. And the people that become professional drivers, the Uber driver, well, guess what? When they have an offering, they're going to say, I drive in so much time 200,000 kilometers, cost versus price.
Right.
It's far cheaper in the long run for that person to drive an electric car. There's going to be far more incentive. So when you look at the amount of cars that need to be made, it's not just the fact that Toyota or GM or Volkswagen has to make fewer cars. Think of the energy input to make, for that 100 youngsters that we just talked about, if you only have to make, instead of making 30 cars, they have to make 20. Think of the energy input, the savings to not make those extra cars. There's a cascading effect that reverberates through the global economy. And if you look at the impact on copper, those cars that become electric, they require 4 or 5x more copper per vehicle. So once again, even though car sales are falling off, that's going to impact things like aluminum and steel and oil demand, but it's very robust for copper because it's offset with the 4x or 5x more copper required in all the new vehicles that are electric.
Okay, I really want to get to copper in just a bit, but I'd like to also ask you regarding these electric vehicles. Nickel, cobalt, they do play a very big role in the battery for these electric vehicles. Do you foresee the demand for nickel and cobalt to increase in perhaps the next 10, 15 years?
I'll tell you a story, Patrick. When you look at the necessity of global industry, when something becomes scarce and very expensive, they have to find alternatives. One example was rubber. When the Japanese cornered the rubber market in the Second World War, where in Malaysia, where most of the rubber it was coming from, the American chemists were able to find a way through petroleum products to create synthetic rubber. So if you would have told someone in the mid-1930s that we're going to have synthetic rubber, they probably would have laughed at you. Out of necessity came a new invention. So if we can acknowledge now there are millions of people working in the battery space. And what it really comes down to is chemistry. And they're working on various chemistries. And it's already well publicized that the pressure point in some cases is nickel, is cobalt, is lithium. Can we get more nickel? Probably. I don't think that's going to be a problem. Is there lots of lithium in the world? Yes, there is. Cobalt is geologically very scarce. So the trade-off is going to be, if it is that scarce and that expensive, I'm guessing that the various teams, the armies of teams working around the world in the next 5 and 10 years, I believe that they are going to come up with different chemistries that are going to adversely impact the quantity, the demand on a per battery basis that we use of cobalt, which it'll decrease it, and in some cases they may be able to actually eliminate the cobalt altogether. I know people tell you because of fires and energy density that's not going to be possible. I don't know. I'm not an expert on that. I just know that there's a lot of people working on it, and there's a heavy financial incentive because the prize is so big. The prize is so large. So I think you're going to see, from what people are forecasting today, is going to change in the next 2-3 years because of technological advancements.
Yeah, that's a very interesting viewpoint that you have, and really I thank you for sharing that. But let's get to copper. The question of the day: why are you bullish on copper?
I'm bullish on copper because in every circumstance, in every scenario, there is going to be demand growth for that commodity. So the CAGR growth rate for copper since 1900 was just over 3%. And so if we look at it, every time that you substitute fossil fuels out of the energy mix, it means electricity, and that electricity requires more copper. So the substitutor for copper, if it becomes too expensive, is aluminum. It's going to be aluminum and copper. I'm not too concerned about things like superconductors and graphene. And if you look at, people always point to the wireless charging, like if you have induction in an electric car, it takes more copper because you have to have the induction has to work in the copper, becomes these magnetic fields have to catch themselves. Right. And on the floor of your garage will be a plate with a copper cable that's hardwired to a panel. So copper wins across the board. So I'm not too concerned about the demand growth of copper, unlike other commodities. We talked about oil. It could be abated. Cobalt may be substituted. Copper is going to be par for the course. The problem on the supply side, we are already in a supply deficit. We are in a time right now that there are no major copper mines coming online until about 2022. This year we have Cobre Panama, so that will come online, but I'm talking about the next 3 years. And there's been a lack of investment in the copper space. Geologically speaking, what we found in the oil business with fracking and horizontal drilling and technological advancements, we found a lot more oil sources, and we found new ways to extract oil out of old reservoirs. There has been no such technology in copper. And the 50% of the primary copper supply today comes from about 25 mines. The average discovery year of those mines, Patrick, was about 1930. We're not finding new copper mines. So even though it's one of the few commodities that is it's a future commodity because it's a technological driver. It's the Achilles heel or keystone to modern energy, and we use more of it on a per component basis. You actually use more copper per item than you do with incumbent technologies. And where does it come from? Fewer and fewer places, harder and harder locations. And we spent a lot of money looking for it in the past 15 years. In the last 2 cycles we had, we did not find too many high-grade sources. We found lots of lower-grade sources, but the only way that those reserves and resources are going to come online is a function of economics and price. And that tells me that we should have. If the world wants more copper, and I believe the answer is yes, the only way that that's going to become possible is a function of making those lower-grade, more difficult location deposits have to become economic, which tells us that it should surpass its old all-time high, which was in the 2010-2011 area, $4.50 a pound, and it's something that is going to have to become significantly higher in price if any of these resources are to be exploited.
Yeah. Okay. I know. Let's say even if there is this electrification of everything, even when it comes to the windings in the electric motors, it's all copper wires. So it is in just about everything electric. The potential upside for investors, is it a good time for them to get into copper now?
Oh, absolutely. Absolutely. Let me just make a quick note here.
Sure.
I think the timing is ideal, where everyone has heard the cliches and the proverbial things where when there's blood in the streets is when you want to be a buyer. But you have this we're trading almost at all-time lows. So if you look at other than the blue chip copper stocks, if you go one tier down, which I like the growth and optionality plays, because if you look at the R&D of the business, which is the future reserves, they trade at a dramatic discount to anything in reality for production assets. And even the production copper companies are trading at a discount on a PE basis or whatever metric you want to use compared to the stock market, which is effectively just went up and up for 10 years. So it is absolutely a contrarian play. And if you look at my mantra with one of my mentors, Don Cox, never invest in the story on page 1. That is the efficient market. Invest in the story on page 16. That's headed to page 1. Electrification is already there. The electrification of transportation, people talk about it today. But if you look under the hood, the secret to all of that is copper. And this is a totally underappreciated reality. And I know this because when the world's largest gathering of energy executives, they talk about all these things. They acknowledge the future's electricity. They know what's going to happen in so many years. But you know what's never mentioned? The word copper doesn't get a line item. And that's for any kind of investor that wants to invest in what's not talked about. I will suggest to everyone that is the theme. Not only electrification, because when you understand that, you start to solve the puzzle. But when you look at what makes that electricity possible and the fact that the power of magnitude more copper required in each and every component within that modern energy takes more copper. Then when you look at where does it come from, and those assets have not appreciated and they're still trading at all-time lows, that is a classic contrarian investment. And I think that's what people need to look at. And if you read my book, it'll give people additional information that's not stale dated to fortify that understanding on why right now copper is that type of contrarian investment.
Okay. Gianni, how can we find that book, My Electrician Drives a Porsche?
If you go to Amazon, it's available as a hardcover book, a softcover book. It's also an ebook for people that like to read on their e-reader, but it's also now available on audible.com for those that like to drive and listen to the book. You can also get a lot of information on me and different videos on to fortify these topics on a company that I'm the executive chairman of. It's called CopperBank Resources Corp. Yeah. And our website is copperbankcorp.com. And that is another way that people can play the optionality in copper. It's growth and optionality. We have a large technical team, and these are assets that are not in development. It's a real estate play focused on copper, and I think people would should follow that story because I think that's a very good opportunity for those that are looking for that kind of growth and optionality within the copper space. Where copper is mined happens in very few places. So I've already talked about the oil supply. It comes from 4,700,000 individual wells. The majority from very few countries, and it comes from very few operations, right? Yes. The world's largest producer of copper is Chile, and most things are not going to be price sensitive because if you have, for example, your average air conditioning unit, the one that you see in all the apartment buildings around the world, these things cost $800 to $1,000. They have about 15 pounds of copper within them. So if copper is $3 a pound or $5 a pound, there's not that much impact. There's not that much impact on the actual component itself. So the global industry can tolerate a higher copper price. I don't think it's going to be that much incentive to substitute to other things. The substitutor is aluminum. And there's a special metric there. You have to follow it. It's 3-to-1 to 4-to-1, the price differential. Okay. So the financial incentive to substitute into aluminum is taken away when that ratio is kept, for the simple fact of cost. And when you're using aluminum, you're using an inferior product. It's 70% less conductive than copper. You need more of it. There's more failures. The connection points fail. People have done these examples. There needs to be a pretty dumb application of electricity to substitute into aluminum, but it is part of the solution. Everything will not be able to made out of copper only. It'll be made out of copper and aluminum.
But getting back to CopperBank, could you let our listeners know the business model and the projects that are going on with CopperBank?
Yeah, we have 4 projects in the company portfolio, and we purchased projects that had a significant amount of drilling and economic studies completed on them already. And effectively, our portfolio, we've just announced the acquisition of another project in Arizona, but it would take in excess of $120 million to duplicate all the drilling, engineering, and metallurgical work that's happened on our various projects. We have 3 criteria. 1, our children have to be able to work at the projects that we own. That means we're sticking to safe jurisdictions. In our case, we're all with a private property component in the United States of America, Alaska, Nevada, Arizona. They have to be projects that had a lot of money spent on them. There's enough risk in that business as already. We want to take that away and buy the research so we understand these assets, which they're all tier 2. None of them are tier 1, but that's the optionality within the opportunity. And number 3, we feel that these projects are located and they have enough resource delineation that when the market normalizes, a more senior company would want to partner or acquire these projects from us. And if we're paying 2, 3, 4 cents on the dollar, that's where the lift is. Right. And every time that we do a divestiture, we aim to create like a share dividend for our shareholders. So you would multiply our one CopperBank share in the future as the price normalizes. You multiply your exposure to copper, with each project representing another potential share as an opportunity for our shareholders. We're fully aligned with our shareholder base. We as management are the largest shareholders in the company, so we take dilution very carefully, and we're highly motivated to see this take place in a normalized copper price environment.
Okay. And
we should also talk about, Patrick, one more thing. The price of copper has recently fallen, and a lot of that has to do with this trade war discussions. And as we talk right now, it's the 2nd of August, 2018, so just to stamp it, we've seen this overwhelming negative economic sentiment because of this trade war and tariffs that are being bountied back and forth between the United States and China, and then Europe and China counteracting that. This will counteract itself, because the copper market, in any event, is going to be in a deficit. Whereas in the short term, the industry around the world can start to live hand to mouth with respect to their various inputs and materials, copper being one of them. But eventually, that hand to mouth, it does continue in the economic circle, and we will still be in a supply deficit with respect to demand. And so the dip right now is something where the copper producers of the world are hedging themselves, and you have this summer doldrums, you have this negativity with trade war. It once again, it compounds the near-term opportunity in the copper space. This is I think an opportunity for people to at least start following as a baseline the copper price and various copper investments.
Right, and I think going forward with the electrification of everything, do you see copper going into even more of a deficit?
Oh, absolutely.
Yeah.
CAGR growth rate of copper has been 3% since 1900. I believe it will be something steady, but in fact, if all of these things continue to amplify the amount of electricity within them, demand for copper should actually grow. So be it 3% or 4% or 5%, it's going to be growth. There is no supply growth. I reiterate, there are no major mines coming online in 2019, 20, or 21. That is a classic supply and demand imbalance, which in most cases gives you price reaction, and then eventually, when it becomes more of an attractive price, of course that will spur additional supplies. But that takes a long time. When you press the play button on a copper mine, it takes 5 or 6 years before it comes online. And so you have, it doesn't matter what's going to take place in the next 24 months, because when these big, large companies start building copper mines, they come years and years in the future. It's not like oil supply.
You've definitely perked the ears to our listeners on copper, Gianni, and we'll be sure to direct them to Kovacevic.com and as well as copperbankcore.com to get more information on your work.
Yeah, copperbankcorp.com is where we have a very nice video archive there. Absolutely. Thank you so much, Patrick.
Okay, yeah, sure. Thank you also, Johnny. We really do appreciate your time, and good luck with your ventures.
Thank you.
Thank you also. Take care.
Bye-bye.
Bye-bye. That was Gianni Kovacevic, Executive Chairman and a co-founder of CopperBank. For more information of his book and his views on the resource sector, please visit his website, kovacevic.com, and go to copperbankcorp.com for more information about CopperBank. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content.